I'm a little confused. I've been quite confused recently by the regulator. So the regulator is talking about incubating a new product class altogether. Do you think it's the regulator's job to do it? So I'll start with Dhirendra.
No, the regulator has incubated everything. So it is the job of a regulator. Regulator incubated mutual funds.
No, no,
So
no, no. No, no.
the open-end
Mutual
funds.
funds were a class which was existing. This new asset class, which we are talking about, does not exist elsewhere to the best of our knowledge, has not existed in India. There has never been any talk about having such a product in the public forums. So, to that extent, the regulator is giving birth to a new product category altogether. So while I understand that by facilitating, they normally facilitate, they make it easy for industry players to function by setting out the rules and the policies and the framework and all
I'll
that.
share my perspective on this. Okay. One is that, regulator is doing it out of fear.
Okay.
Because the way PMS, AIF has been democratized and the way they are lightly, I'm not talking of all PMS players, all PMS participants, but sundry and crooks can gain access to this industry segment. They are relatively not as tightly regulated as mutual fund. Mutual funds are so credibly regulated that it is very difficult for anybody. So I think it is ring fencing. And they have understood the scale of things, how PMS, and at some point, the regulator has understood that the tactical sales pitch or flexibility enables a very different kind of sales practices, which in case of mutual fund, it has been able to tighten, put the guardrails, which in this case, they have not been able to. In fact, if they are able to mandate the pricing of this new thing, it may not take off in the first place. Because this is a beautiful product. No, the PMS as compared to this new product is almost like a PMS with 10 lakh rupees denomination instead of 50. And it has the tax efficiency of a mutual fund, which is unthinkable, because that is brilliant. But the point is that if it is going to be priced as mutual fund and regulated as mutual fund, then nobody will be interested in selling it.
But why? I thought it would be the other way around. This was a PMS product with a higher level of safety, higher level of transparency, and perhaps a better pricing because...
I think, you really have to understand the first chapter of the book which you gifted me 5 years back, which is Influence. Which said that, incentives play one of the biggest role. Okay. And the incentives are completely misaligned, but they are so rewarding that it will be sold. You have to really understand how AIF and mutual and PMS is sold and what is the incentive in it and what is the cost framework of it. And I really wonder if I have to look at it objectively, if as value research we have to look at it that should you invest or not, I will say wait for 3 years. And after 3 years, possibly, and 3 years is very generous, ideally 5 years. You will actually you will be able to figure out that all the flexibility and everything is translating into something meaningful for the investor. But going by, this PMS and AIF success, I feel that, if it is the cost framework is tightened, which we'll get to know in greater detail, then, it will be a different story altogether.
If I can just add to that. So the structure is that there are 37 categories. Every fund house is allowed to have one. Now, suppose I'm a fund house and I have one large cap scheme. And I will play on the top end of the large cap, but there are 100 stocks. I might want to play on the lower end of the large cap, but I can't do that. So this strategy-based product category allows for the fund houses to run different strategies. So see, this has been debated for years. So when the whole categorization, and I can tell you from inside of the debates as part of the mutual fund committee, that it was a hard-fought decision that should funds be allowed more than one scheme per category. And the idea was that they are launching too many Me Too schemes. But on the other side was this genuine demand that we can't run our strategies. I might have a very different mid-cap strategy. I think it solves for that. And it's also giving a regulated way for people to, I think there was a lot of investor interest in things like small case, right? So it's the way that I see this regulator working is to say that if there is a market innovation, can we make regulations around it instead of banning it? Because in any case, it will run. So I think I would imagine it's a very mature regulatory step to say, let us allow more competition, let us allow more products, and then leave it to investors to decide whether or not they want to take the risk.
Okay. No, I was worried about something which can come back to hurt the image of the regulator tomorrow if anything goes wrong with that product category. It's a market-linked product, finally. And for SEBI to put all its might behind it and promote it, this has not been all of us here in the hall, as far as our knowledge is concerned, there's been no talk or demand for the product in a public forum. It has come through completely out of the blue through one of the announcements of SEBI. And hence, I thought there was a reputation risk if anything were to. Yeah.
So, Prem, let me tell you one thing. Because I come from the banking background and right now I'm in the mutual fund. And I have seen 34 regulators across the world. This is one regulator who does anything on a consultation basis. That's a point number one. I have never seen any of the regulators of this kind. One regulator who does it. And second thing, most important thing, as you were saying, that it has been brought out by the regulator. It's not so. The original proposal was originated from the industry itself. We went to the regulator saying that this is the top scope which is available. This is where we would like to introduce these type of products. Please give us an approval for that. That's how it originated. Okay. It's not driven by SEBI. And there are multiple iterations happen between the regulator and the industry body, and of course our members. And subsequent to that, through MFAC and others, we brought it out. So let's make it very clear. Anything that is being done by the regulator, SEBI in particular, is done on a consultation basis and not brought on their own.
Okay. Yeah, DP, sorry.
No, not only this, they didn't have discussion at the MFAC or MFI. This is the first time where chairperson herself had detailed discussion with the fund managers, how to manage it. So that's going further down the line. So a number of consultations happened. Honestly speaking, it's as Madam said, it's a very, very mature step. They wanted, mutual fund is a very tightly regulated, then PMS is very loosely regulated. They wanted to bring in something in between. So it remained regulated. People don't burn their fingers because they will, the regulator will always have a control over this. So this is something I don't think there's anything wrong in this.
Okay, great. So this has been a step which is obviously, while it is not known to outsiders, it has been something which is where the industry has clearly, I stand corrected there. Yeah. And now let's move on to, there have been two important committees, Monika, and I think you've been associated with them in some way, the Swaroop and the Bose committee. So why don't you tell us a little more about what these committees are all about and what could be the implications of these committees for us?
And it's also, I think, important for the people who in the industry to understand that the regulations come in after policy decides the broad direction of the market. So Swaroop Committee is 2009, and I was fortunate enough to be leading the research team there. And that was the first argument in India in favor of the retail investor. Till then, it was very corporate driven. There wasn't nobody thinking of the retail investor at all. So that was the first argument which put financial literacy and investor protection out there as a concept and as a roadmap of the idea was to hard code consumer protection into the structure of the product. So why do we have the mutual fund product the way we have it? Why are there no front commissions? Why did the NFO charges go away? Why are the disclosures so tightly mandated? Why are the expense ratios the way they are? Because there was a policy decision 2009 Swaroop Committee, 2015 Bose Committee, again I was a part of that, where it said that because financial products are invisible, you have to hard code consumer protection into the structure of the product so that mis-selling accidents are reduced. We can never eliminate them, but they're reduced. Now you see that SEBI as a regulator, through subsequent chairpersons, it's not one, I cannot name one, starting from Mr. Damodar and Mr. Bhave, down the line, each one has taken that policy thought forward. And therefore, when you see the SIP number, when you see the growth of the AUM of the industry, I think some credit must be given to the policy thought, where you see in parallel an industry which simply did not follow that line of thought. So insurance simply discarded the 2 committee reports, SEBI implemented it. And you can see in terms of the trust of the investor. Investors are aware of the product, mutual funds, and they have a good thought about it. There is a bad smell about insurance. They did not implement these 2 committee reports at all. There have been some changes, it's happened after a lot of struggle. But, I think we need to understand that regulations might seem as if they're coming out of nowhere. But one, it's based on a policy view of the market. And the good news for people like me who have half a policy hat on is that the ideas that we had 15, 20 years ago have shown in the growth of the industry. Who's the most innovative in the distribution space? MFDs. Where is all the good fintechs coming? In the mutual fund space. Why are we not seeing more in the other verticals? Simply because this regulatory thought has made the product so that investors feel safe. So just a small background on why we are here today with SIPs of what, 25,000 crores, sir? Mr. Singh, 25,000,
Yeah,
24,000.
24,000.
So it hasn't happened by accident, it's by design. And the potential, of course, is of 2.5 lakh. It's not just 25,000, it's a multiplier.
Yeah.
But that's the next. So the next 20 years will take it there.
And it's global success story. Nobody has been able to replicate that because of the regulatory.
It's a first in the world
frameworks. Yeah,
where retail investors line up to buy a product which is risky. There's no 401k, there's nothing. So I think there is some merit to saying that we got this policy right.
Okay. Now, DP, I come to you. Very often it is said that, the views of the distributors are not put forward to the regulator properly because AMFI is finally a manufacturer. I'm just playing the devil's advocate. The manufacturers have access to SEBI through AMFI, it's their body, and hence distributors. So there is a feeling that our concerns, our issues are not addressed. What would you say to that?
Partly yes, partly no, but majorly I tell you in the AMFI committee or the ARN committee, ARN holders committee, where most of the sales people are there. I think that is the most active committee amongst all the committees. And the aspects, the viewpoints of MFDs are definitely taken care of. But the issue is from the MFD's point of view, there are three buckets. One is the product, one is the investor centricity, and third is the distribution cost. Good or bad, distribution cost first, which is the most concerning thing. There we have the graded system, and there's because the industry has grown so much, and very very less time in 10 years. If you look at it, it has moved from 6 times, 7 times there. But the cost which is regulated, which is being charged by the manufacturer, it has come down drastically. So there is a huge gap between one player and the another player. This is creating a lot of confusion, and we are taking up with this because once that is taken care of, if there's some kind of, I will not say sanity because that will not be liked by the regulator. yeah, that's not the word. But thing is, there's a huge gap. mean, there are funds which are charging 2.25%. There are funds which are charging 105 basis point or 110 basis point. The huge 50% gap. So once that is taken care of, that part will be taken care of. Will be there. But on the investor centricity side, I think a lot of trainings are happening. A lot of financial intermediation is happening on behalf of the trade body as well as people. In fact, I was discussing with Mr. Dhirendra Kumar just before this discussion. There were times where there used to be huge, investor melas and so on and so forth. But this is a very, very serious financial product. It cannot be done or sold in melas. Or it cannot be, the education cannot be imparted where thousands of people are there. So it's a very, very, pious work which is being taken care by people like Monika Halan madam through her writings, or Dhirendra Kumar through his writings everywhere. So we were discussing, if rather than having a small discussion where 100, 200 people are there, but the I think fintechs have created a real success story. And I think from that point of view, yes, there's a competition for MFDs, but when I look at it, the percentage of direct business in overall business is still not that challenging. So there's a they feel that they are not being talked about, but I tell you internally, their point of view is most vociferously being put in by the manufacturers with the regulator, and the regulators are also very, very conscious about this fact that there are so many thousands of people are earning their livelihood through this business.
Mr. Chalasani, I have one question to ask of you. AMFI does a lot of heavy lifting as far as regulations are concerned. Okay. Is that correct for AMFI to do something like that, or just say, we are lobbyists and it's the job of the regulator to regulate? We will talk about the growth of the industry and let someone else look after the regulatory aspect. So there has always been this attempt to make AMFI an SRO in some way or the other. There have always been nudges towards it, right, Monika? Yeah.
There is an SRO now.
Yeah. So.
There is an SRO, right? With the Bombay Stock. No, you're not an SRO, but there is an SRO.
Padai is SRO.
So, how do you, as the AMFI CEO, how do you look at this? What do you think should be the role of a AMFI? And in that, how do you look after the interest of both the manufacturers and the distributors evenly?
Yeah. Before I answer that, let me supplement what DP had mentioned about the distributors. Let me make it very clear, as far as AMFI is concerned, when we take care of the interest of the manufacturers, that is the AMCs, and these people also give equal importance or more importance to the distributors. At least my experience, what I've seen, we have an ARN committee where how to improve, how to impart knowledge to distributors is always discussed. And one important change that we are bringing out from this year onwards is to recognize the best distributors. We're going to have MF Summit very shortly. We're waiting for the finance minister's confirmation. Once that is done, we are going to have it, and we are going to have a distributors recognition program where the different distributors from different areas are going to be recognized. So we are giving due importance, and we recognize that they are the most important people for our industry. Let's be very clear about it.
Great.
The second point that you talked about, see, ultimately, it's if the industry has to grow, the mutual fund industry has to grow. The paramount point is the investors' interest, investors' trust is something that is extremely important. As a industry body, as a trade body representing the AMCs, even if I do something on behalf of the regulator, I look at whether it is going to be useful, going to uplift the industry. That is what I look at, and whether the proper risk management is being done. We participate in the various discussions and see that this is going to be in the interest of the industry, and we are happy to do it. I had at least not felt that I'm doing any heavy lifting for that. Because, as I said in the beginning, the consultation process that regulator does is phenomenal. anything and everything. Even today morning, I had been to SEBI to discuss about a particular point which needs to be changed. They are not very sure. They don't say that, Venkat, you need to implement it. And they do, and I need to do the heavy lifting and pass it on to the body. They listen to us and then make the changes.
Okay, that's wonderful to hear.
And I'm very happy the way they do it. And I was a chairman of FEDI and an SRO, which is an SRO.
Yes.
When compared to that, I find it much, much better consulted, better regulated, and therefore I'm not at all feeling that I'm doing that.
No, we recognize that. Having said that, I think it's the SEBI AMFI relationship epitomizes almost a very dreamlike this thing where there is a lot of trust. It's a lot of consultative, though perhaps things were not always this way in the past. But over the years, in fact, I'm told at your AMFI annual general meeting, there was a lot of praise from the regulator about the actions taken by AMFI, some of its members, and so on. Having said that, I want to come to one point, which is, in your opinion, Dhirendra, one measure taken by SEBI which has changed the fortunes of the mutual fund industry the most? Each one of you.
I would say the setting off of the principle of, there are two principles which I think is crucial to SEBI's framework of regulating mutual fund. Fee transparency. And second is the product framework. The whole belief in we will be empowering investors with a set of information which will, which actually creates, if you look at the state of disclosure, the frequency of disclosure, and I've been part of mutual fund advisory committee for nearly 10, 12 years alongside Monika, and what I can tell from, I'm just going back to the previous question that whether AMFI is a trade body or a SRO. I think AMFI people represented in the MFAC as a fixture have always actually behaved like a SRO. They have actually been a quasi-regulator. They really don't get into the very petty discussion that give me 25 basis points more or less or this or that. I've never seen that. So the conduct is of a different kind, though they are that very design of AMFI is that of a trade body. Okay, so I was coming back to the question posed to me, which is the product classification. Look at the disclosure, look at the riskometer. I think it is a whole new standard. If you look at the fact sheet, which is not even a regulatory mandate, it is a voluntary disclosure which was invented at Khatri, pioneered by you every 3 months, has actually become an industry standard of voluntary disclosure in a structured format, which has now got some kind of official sanction. That if you do it, then do it in a standardized way. The definition of everything being put so that it is comparable. Nobody doing things. There is a definition of a turnover ratio which is discussed and understood and actually narrated in the same way. So I think these two standards, fee and this product disclosure standardization is a very huge thing.
Okay. DP, which are the two things
I know,
which you've been the happiest about?
I'll say 3 things.
Okay.
Not 2 things.
Okay.
First and foremost, the banning the upfront commissions was one of the best steps, which was seen as very, very big disruption in the market. But it has been a blessing in disguise for the industry, because that was the tool for mis-selling. Most of the funds were being sold on the basis of how much I am passing back. I've seen where the upfront brokerages used to be as high as 5% and 6%.
Yep.
So that was Panagar, and everybody was doing the same story coming out with the app, because that changed the whole. And I still remember there were comments that now the industry is gone.
Yes, of
gone
course.
for a toss. That is number 1. And number 2, the most important, when they brought in this 2 basis point investor education fund, and that from where it started, mutual fund sahi hai. The kind of trust, the kind of respect this industry is having today from all the stakeholders is only because of the beautiful campaign of mutual fund sahi hai, as well as the so many other investor education, the whatever the steps have been taken, whatever the initiatives have been taken at different levels, at the not only at the trade body level but at the fund house level, because they have a financial muscle to push the financial literacy. But we have learned over the period of time what kind of financial literacy is really making a difference. As I talked earlier, earlier we used to have big meetings where thousands of people are coming and we're spending a lot of money on hiring the hotels, so on and so forth, but it has moved from there. And the third was this getting the penetration into the smaller towns. This B30 initiatives, giving little higher brokerage for a particular period, for a small period when it got penetrated. And see, these three steps have actually made. But amongst these three, the mutual fund Sahi Hai campaign or the investor education initiative taking out 2 basis points has really made a
Yeah,
difference.
definitely. That's but yeah.
Yeah, that's a problem of speaking with a third, you know. I know you have much more
I have
problem.
nothing left to say.
Because I was thinking about the mutual fund Sahi Hai, which
Yes.
the campaign which was started, and it's a phenomenal. I mean, all the niche products have become a very popular product now. You look at the other day, I was thinking of the current chairman of State Bank, who's talking about introducing a SIP in deposits. I mean, people keep talking about insurance Sahi Hai or SIP and all those things. So that is something that made a phenomenal change. But since it is already consumed by DP, let me talk about something new. One of the things that I was debating from the time that I came into this markets way back in 92, 93 is the liquidity in the corporate bond market. And uh, when we talk about valuations, we look at anything today, it's the valuation is for the corporate bond is what we see. But when you really execute it, you find that market is totally liquid. And the most important thing that at least SEBI, which is done, which no one else in the globe has done, is the introduction of CDMDF, Corporate Debt Market Development Fund. And that is something which will ensure that if the quality of credit is good, but liquidity is not available, then the CDMDF will come into action and ensure that the corporate bond liquidity is made available. That is a phenomenal change. Apart from, of course, mutual funds, IA is the best and disclosures is the best in the world. I was talking to ICA and all. Nowhere in the world these disclosures happen.
Yeah, no way.
And so these two are consumed already, so I had to take something.
CDMDF is also the global first.
It's a phenomenal.
Sorry?
Backstop
This
facility.
backstop
We have to see that
facility is
it
globally
still has
first
to
time it has
undergo. In fact, I was very much part of the discussion while it was evolving. The whole idea of this is that just by having it, it's like a nuclear bomb.
Exactly.
It's a credible threat. It won't let something happen.
That's right.
So
And,
you know,
and I think SEBI used every crisis. I'm not naming any fund, but we had a problem
will
in
ensure that we
2020
will not have a repeat
with
of
funds
bank
being
intervention.
frozen. So SEBI has taken that as a problem in the market and solved it with the backstop facility. And since I'm last, I'll just tell you a couple of stories because DP has taken up all my points, and so has Dhirendra. But see, the finance, the whole story is about incentives. You have to put the incentive in the right place. What we have today is a trail model, which the manufacturer, the investor, and the distributor, all three benefit. So finance need not be a zero-sum game that, like, say, for example, insurances. The agent wins, the company wins, the policyholder doesn't win. So in this case, I have to credit, so the first change happened with Mr. Damodaran. I don't think this age will know that there used to be something called the 6% NFO charge. Mr. Singh will
Yeah,
remember
of
that.
course. Which used to be expensed off. Or you could
6% of the NFO
amortized.
collection.
amortize it also. Yeah.
Of the NFO collection, 6% was amortized over 5 years. So I was, I was in Indian Express that time. We ran a series of stories calculating the churning scam that people were coming with NFOs, harvesting it, and churning. There was a bull run on that time, 2004. So Mr. Damodaran then, I remember he called me up. and said that we are going to remove it for open-ended funds. So I said, why not closed-end? He said, they are good boys, they'll behave. I said, they won't. So he took away that charge for open-ended funds. In the next year, there were 42 closed-end, number of open-ended funds. And then before he demitted office, he shut that window as well. So this is 6. And then 2009, so this got over, but there was a 2.25% entry load.
Yeah.
So they began to churn on that. So that time I was in the Sarup committee. I was out of journalism, but the whole policy thought was that we need to align incentives. So I remember meeting Mr. Bhave and he said, let's ask the question, whose agent is he or she? If he's the agent of the mutual fund, there are no commissions. So 2009, I remember the bomb which went off in the industry. He just gave, I think, the industry 2 months, 3 months. And everyone said this industry is dead. I remember one insurance CEO met me at one of the airports and said, you've killed the market. I said, we'll see. We'll all be here in 10 years. Let's see who's killed who. He said, this industry is over. That was the impact of that removal of that front commission. And because that incentive structure got aligned, we have seen this growth. So in my opinion, those were the two foundational building blocks of getting the product to the stage where it is today.
Okay. So continuing with you, Monika, since you didn't get to make original points, I'll give you an opportunity to make an original point, which is one regulation which should not have taken place.
Regulation which should have not taken place. I am not certain there is one like that.
Okay.
I'm not certain that there's a regulation which shouldn't be there. I think the regulations are pretty, and also if there is, so again with SEBI, we've all had long associations, all 4 of us here now. I think there's a very consultative approach. So if there is a problem, and we've all been in meetings, industry comes in very aggressively. There are a lot of heated arguments where the industry is pushing on its point and saying this regulation doesn't work. At some point, SEBI says, as a regulator, in the investor interest, we'll force it. But otherwise, I think it's very consultative.
Okay. Okay, but sometimes procedural things come and create a lot of problems. And one of the sore points is regarding KYC. The norms keep changing and then deadlines are announced कि ये नए norms हैं and you have to start confirming it, with the result that a lot of the time, energy gets wasted in that because your client's money is at risk, So what do you have to say? Why can't, first of all, we fix, as I think one of the 2 committees did recommend that there should be uniformity in KYC norms and they should be applicable across products, categories, regardless
I
of
think in the capital market
Yes.
regulated by SEBI, it is so. Correct me if I'm wrong. I think the problem is of KYC across banking and other sectors. And I think we have to lob the ball at the Ministry of Finance because the CKYC was supposed to sort this mess
Yes.
out. Because like Aadhaar, if you can do Aadhaar, why can you not do CKYC? CKYC, so what SEBI does when this whole KYC, it is authenticated that indeed so-and-so is, this is the address, so the entire KYC is authenticated. CKYC, I don't know right now, but it was not authenticated. It was garbage in, garbage out. So even RBI,
legal issue.
and you could correct me, sir, even RBI, I have seen the regulation where it said that KYC, the CKYC is not applicable. You'll have to go to the branch. So I think the problem sits with the Ministry of Finance. They need to sort the CKYC, which then is given to every regulator to implement.
I would like to just clarify that what exactly is the problem. The problem is complying or being, authentic with the Prevention of Money Laundering Act. That is the statute on the book, and everybody is, and it holds anybody accountable for any money pouring into the financial system, and it must be validated. It cannot be passed on to anybody else. SEBI has made an exception that if one of the SEBI regulated entities or intermediaries have validated we will take it as good, and there has become a central repository. So the CKYC, we have our CVL and things like that. This requires amendment in the Prevention of Money Laundering Act, that once done by somebody, whether it be a bank, because that is how it works world over. If you have a bank account, it is taken as good enough for investment. Because and beauty of mutual fund is that the moment it will be a magical leg up for mutual fund industry. Because mutual fund, when you were asking that what one thing, it is not one thing, it is about 100 things. Because money can come only from an investor's bank account. Money can go back only in the investor's bank account. These are very huge things. Earlier I have seen that mutual fund, some intermediary will take the money, get the form filled, get the check, and actually tear off the form and put his money, take the redemption proceed and disappear. And it was not a one-off thing. This is something which Mr. Bhave did do away with completely. So 100 such things happen. This PMLA thing is resting with the government, and it cannot be solved. But where SEBI or all other intermediaries or some of the service providers have been a disaster, unmitigated disaster, is the way it works, the way you are able to do your KYC. There are broadly 3 kind of investors who come for the digital roadmap or journey. Somebody is KYC'd, somebody is not, sir, somebody is a first timer. How do you get him on board, even if he has Aadhaar card? If he is complying with everything, some systems work, some systems don't work, things are not transparent. We have a prescriptive regime of regulation, but they don't get too much into detail, and that leaves flexible thing. And that is why somebody comes up a few months later, few years later, that this is not good enough. And these are extremely inconsistent things.
Just let me supplement what other speakers have said. It's very simple. I mean, we came out with an ad also saying that KYC Sarala hai, where MS Dhoni had explained how it is to be done. There was a lot of hue and cry. People did say that it has been made tough, but the fact remains that if you are getting your documents, your identification and address validated. Validated means I do it online validation. Once it is done, you can do with any of the AMCs that are there. You can operate with any of the AMCs. It's so simple. If you are not validating your documents, means you are submitting officially valid document, but I am not in a position to do online validation. Means you give a driving license or you give a passport, which I am unable to do an online validation, then I do what we call it as registered. And if it is registered, it can be done only with that particular AMC, and I'll not be able to do with other AMCs.
Got it.
It's just overall confusion was created in the media, and we had to give that clarification. Let us be very clear. And second important thing is this is being driven because there are a lot of money laundering. We want to ensure that the investors' money is protected. That's the ultimate objective. So small hiccups of this kind should be acceptable. In fact, in the banking sector, we do a review every 1 year, 2 year, 3 year, depending upon the categorization of the individuals. If it is politically sensitive person, then I do a review every year. So we categorize the customers and then we do a review of this KYC on annually or biannually or once in 3 years. Here is a place where we are saying that please validate your document. Once it is done, you can invest anywhere. But the point that which ma'am had spoken about, where if it is implemented across all the financial sector, be it insurance, be it mutual fund, be it banking sector, then things will be much more easier, and we're hopeful to see that in the near future.
Okay. Now, I wanted to use this forum for you to share with the audiences what are the changes, what is the drift of regulations, where is it headed, what is the philosophy, what is driving it, what is something that they can expect over the next 1 or 2 years as far as the regulations are concerned. It could be about pricing, it could be about disclosure, it could be about anything.
I think we've just seen the signal from the new product category. That you have a regulator who's very aware of the fact that innovation will happen in the market. We, as the regulator, our role is to see how we can regularize it. How can we regulate a business activity? It's a very socialist thing to ban everything. They don't want to ban it. They're saying, let it happen at a certain size and scale, we will put regulations. So I don't think we can, who knew what fintech would do? Who knew where this market would go? So I think when we look forward, we can just think that innovation should not stop, but the regulator will come and put regulation around you, and you are safer with the set of regulations, because then there is a paradigm in which you are operating and there are clear do's and don'ts.
Okay. And what was the one thing you would alert this audience to?
The only alert is, look, there is no alert. There is only an opportunity. So post 91 was that big reform. Last 10 years, we have seen a series of reforms. So for the younger generation, that 91 moment is here again. Okay, that big wave of growth will take, this is the next wave. From, the GDP has grown from what, 300 billion to 4 trillion in 30 years. 4 trillion to 40 trillion will happen in the next 30, 35 years. That's the opportunity. So if this is a long gestation business, but once you get over it, it's an annuity. I have said this forever, I will keep saying it. It's like it says in the Bhagavad Gita that bitter, something which is initially bitter leaves a sweet aftertaste. This product is like that. Initially, for the distributor, it's very hard work. But once you build that trust, it is an annuity. You will have to refuse clients.
Okay. Okay, Mr. Chalasani. Would you like to share more details of the initiative that you've taken up for distributors? Because it's still not very well known among distributors that there is going to be a reward and recognition program.
No, that we have already started this particular program, and then maybe by January, February, once a date is finalized, we have already declared what categories are going to be there, so that the distributors in each of the category, whoever is the best, we are taking all the data from the CAMs and K-Fintech, and once we get the data, we'll know who are the winners, and we're going to recognize. It's like IBA and others who are recognizing the best of the people. Here also we want to recognize.
So
that
do people have to apply for it? No.
No, not required.
No, it was
Absolutely not required.
absolutely not required, and this is going to be purely based on quantitative.
Exactly.
Okay.
Exactly.
So in fact, I just want
Total objective way of selecting the best of the people, and we'll be rewarding them.
In fact, just to let you know that for the second year running, we'd announced a set of awards today, which were based purely on quantitative criteria, and some of them actually overlapping with what AMFI is going to be doing.
Yeah, you're doing a phenomenal job.
Thank you so much. And DP, so one thing that you would advise this audience about, whether to fear regulations, to go with regulations, or be more proactive, and have a discipline where your own self-control makes sure that you do not see regulations as a hurdle because you follow the best practices.
Yeah, I think the proactiveness word which was used is very, very important, and all the MFDs need to work on that. Proactive in the sense that we have to see how my business is growing. I always suggest people that whatever is your AUM, whatever is your business, at least 1% of that should be your SIP book per month.
You should be your
SIP book.
Oh, SIP
book. That will build up over the period of time. And one more thing, going back to your previous question, I know we had discussions with the chairperson also. I think there's a difference between how RBI is regulating banking and how SEBI is regulated capital markets. So definitely our regulator is more stringent than the banking regulator for sure. Because we have never seen that the bank accounts are frozen, that nobody is allowed to withdraw the money till the time it is done, so on and so forth, which happens in our industry. That is something which I think regulators have also understood, and they're much more practical now. And whenever we talk to them. But now this one thing, which I think AMFI and the industry took up very, very strongly with the regulator, and they came out with various timelines which went on going from one timeline to another timeline. So the point that they are not being, their point is not being taken, that is one example which was done. And second, we have also taken up that with the passage of time, because the difference between our KYC and the banking KYC is that bank account can be opened only with Aadhaar. But in our case, we need a PAN also. And then PAN, Aadhaar validation, the linkage also has to happen. And we have in our country the practical problems of different name on Aadhaar and different name on this thing. Somewhere your parent name is there, so on and so forth. So those things, practical things are there, which are being taken care of. Third thing, which we did talk about, that this 50,000 limit which was kept for the simple
Cash.
KYC.
Sorry.
Not only cash, PAKR and Pakran, can it be taken to 2 lakhs? Because if we put the indexation on that period, it will come to 2 lakh rupees. Because with the fintechs and regulator is talking about the sensitization of our products. If these two things happen, which are definitely on cards, I think the volumes in the industry will grow much, much more than what these are. So as far as caution is concerned, caution is that the suitable product for every investor. There's a plethora of thematic funds, a plethora of sectoral funds. These are not suitable for everybody. But in between the new asset class and the person who is already enjoying the diversified class and is a small investor, the sectoral funds can be sold. Please don't sell it to everybody and anybody. That's something which I like to caution them.
Okay. Dhirendra, your last word to the audience here on how to be prepared for regulations in future.
No, I don't know about the regulations, but I am very worried about this set of people who have contributed to building this business and build a practice, because the technological development that is staring at you, you have won the trust of investors, and that is why you are sitting here. You have to make sure that you are relevant and useful. And if you don't embrace technology, you will be a dinosaur, and you will not be meeting here 5 years from now. And how to embrace technology in a manner, because this is the only industry where the backend is always dematerialized. And today you go to MF Central and you are able to get the history of the investment that I made in 1992. And so it is such a beautiful framework or backend which is available. I don't see much of, you have to really uplift yourself. This presents a great opportunity, and this presents one of the biggest threat to what you are doing. And winning trust, being relevant, being useful, this is where all your investment should be right now. And you should be worried. Thank you very much.
Okay. Would anyone of you like to use this opportunity? There are 4 stalwarts here, and each of them have some very unique strengths, and that's why they're here today. So would you like to use this opportunity to ask them any questions? Yeah.
One was this issue which came up where, say, we wanted to lock or, for some time, stop redemptions where there were no nominations. Nominee jab tak nahi hoga, to tab tak aapka kaam nahi hoga. I'm saying whenever any new regulation is introduced, it should be prospective. An investment which was done 10 years ago, it was taken in 2 names, and because there was a nominee, that person did not feel, I don't want a nominee. No, if you don't have a nominee, I will not allow you to redeem, you will not be able to add. Is some thought being applied to, you said there is consultation going on. Doesn't anybody oppose these sort of recommendations?
I think it was, and it was, that's why they decided not to do it. That's the reason. You said, did not anybody raise the voice? Yes, it was told to them that this is not practical, and that's why it was taken back.
Yeah. And this other regulation where the second holder is the ARN holder. An application was made 5, 10, 15 years ago in the name of the wife, and the second holder is her husband. He is the ARN holder, and now people are receiving emails saying, since the second holder is the ARN holder, there is regulation saying, unless you do not give us in writing that the second holder is my husband and he is the ARN holder, and I want to allow him to be there. Otherwise, that person's name is being removed, or you will no longer get any trail commission. Are you even aware of this, that this is happening?
No. We are aware, sir. We are aware.
So let us be very clear. I mean, while there are many genuine cases, there are fraudulent cases also that happen.
Yes.
We have observed that there are multiple applications which are there, not multiple in the sense, hundreds of applications where an ARN holder was a second name.
Okay.
So when these type of things happen, it's a huge risk. Let us understand. All of us today, we are proud in saying that our industry is growing at such a fast pace is because of the trust that is being reposed on this particular industry. And any fraud that happens will break the trust. So therefore, it might be difficult when some of the times we might ask you that there is a possibility that a second name could be an ARN holder. Please give us. But we want to avoid these frauds. Please understand, sir.
So with, due humility, before sending out a letter, at least the system can check that the surnames are same.
Deepak, you made your point. I'm sure they got the message. You can.
No, but sir, just to give you a perspective, in our fund house, I am giving you the name. In one of the small states, northeastern states, one distributor was the second nominee in 484 cases.
Yes.
Okay, just understand. And see, there are cases where one email address was there in more than 1,000 folios. You know, this is being done to avoid any risk, and I will really say that this was the proactiveness at the industry level, this thing, so that there are no frauds. Because most of the frauds happen nowadays with the digital this thing. Digitally, you have the email address, you have somebody else. If today in your folio, I have my email address and my phone number, I can do anything with your folio. So these are the things which we have to do with the new norms of the business. Please take it that this is all being done in the interest of the general investing community, not when it may hurt some people, but in the bigger, larger interest of the investing community and the trust of the industry, it is being done.
Thank you, sir.
Okay. Yeah. Yes, one last question there.
My name is Sandesh. So can you symbol the blue chip fund, equity fund, and that, simple the name, because village people don't understand that name. So simplify the names of the fund.
Okay, got the point.
So, are we seeing a trend towards passives, like all the mutual funds are coming with passive funds? Is MF getting commoditized, as people are saying, and maybe fund managers doesn't have a role, and active funds are going back, and even mutual funds are favoring that only? Or regulator is having some, are we seeing some trend towards that? I'm just asking.
No, see, a new set of investors is being coming, new millennials, Gen Z and everybody. They want very simple, they don't have the habit of talking to anybody and receiving somebody's suggestion, where they don't need to see anything as a commoditized. The index funds and the ETF, the passives, are much more commoditized than any other fund. So there's an interest, a lot of people are coming. And second, let me tell you, when the benefit is no more the upfront higher commissions or something like that, which is fueling more passives or more NFOs. It's more of that with these efforts, with the focused marketing efforts, we are able to get many more number of investors in the market. So that's one thing. And passives, definitely there's a investor class which today is opting for more passives than actives. So that's why we have to, it's a demand supply. We are supplying because there's a demand.
Yes, sir, but my question is, like, there are two trends which are emerging. One is that in many asset categories, like mutual fund categories, you see the passives are outperforming the actives in many, especially in large cap and other. And second, a lot of customers are mainly conscious about the cost and not so much about the return or long-term return, say a 5 or 10 years return, or the risk adjusted return, that what kind of risk is there in the passive. Is SEBI or say regulator or mutual fund AMCs are looking at it, or they're just going towards the trend, and maybe mutual funds don't have active much, maybe PMS and AIF will have fund managers. Just thinking maybe.
No, I'll respond to that. Sometimes we use performance and returns as synonyms, which is it is not. Sometimes performance may be different, returns may be different, right? Take the example of a small cap fund. Small cap index fund has 250, 300 stocks, whatever number is there. But no active funds, no so-called really meaningful active fund will not have 250 stocks. They will have 50, 60 better of the stocks. And these better companies may not give the return equivalent to the index returns. Because in index returns, there are so many other parameters because of which flows are coming every and any, when any stock is going up in such market. But fund managers, when they pick up the companies, they pick up the companies based on various parameters, various financial parameters, not only financial parameters, but the efficiency parameters also. Those companies may not give better return than the index return, maybe in 1 year or 2 years. Then the general impression goes that perhaps fund manager is not doing the right thing. But actually it's the other way around. Fund manager is doing exactly the right thing because to take care of the interest of the investor, not to get into the companies which he feels are not going to perform for long term. So that's why when it's not always white is not white and black is not black. So this is something which fund managers are doing, and we need to trust the industry and we need to trust the hard work which is being done. So it's performance and returns. This is a new phenomenon which I'm trying to talk to you, is not always the same thing.
If I can just add to that, we've been in a bull run for many years. It will take 2 years of an underperforming index for the performance of the managed funds to show. Right? So bull markets never, it's never an uninterrupted run. There's a reversion to the mean. When that happens, that is the time to evaluate your active versus passive. Flagging? I think that would be the job of the
like to
AMFI
bring a
industry
dimension to it.
distributors.
Yeah, Dhirendra, please.
I would like to bring the dimension to it, that why it looks like it is a very happening area. SEBI put an embargo that these are 16 categories of equity fund, these are X categories of debt fund. You can launch only one of these. And once you are done, you can't launch another. And that is when there was a flurry of activity that people had 3 equity large cap fund, they had to merge it, purge it, combine it, and streamline it. There is no such embargo on the index fund. People can launch as many. Mutual funds sometimes are sold as a story. Now then, the third narrative which has been set about index fund, that if you look at the raw AUM number, in fact the culprit is sitting right alongside. People are looking at this big number, 1.5 lakh crore, 2 lakh crore in index fund. That EPFO is writing a check every month, 30,000 crore. And that is what is making it look very big. And that is what leading to, index funds are becoming big. They are not. He has done a deal with somebody who is giving him a lot of money. And, that is making
But
them
now
look
I
big.
think other people are also getting into the game, right?
Yeah, they
It's been
might. But
opened
what
out.
I'm saying is that,
Yeah.
this is actually, you know what I mean?
Yeah.
When people on the road get excited about investing in fund, it's a different story. When few people get excited about investing in fund and that fund gets, and why they are investing in index fund is exactly the wrong reason why investors should not invest in mutual fund, in index fund. Why EPFO has decided to invest in an index fund? So that nobody is charged of any malpractice. So that nobody can blame anyone that he took a bribe and put money in this actively managed fund. For 3 months, they underperform and it is not hitting the headline of Economic Times. It is saving their skin. I'm just saying, not putting the right organ there. It's guarding their, this thing. In that sense, it is being done. Indian individual investors, they have something themselves to, I would say that you remember something called HDFC Prudence. It was not beating the benchmark. It used to, you know about Unit 64. Investors have a very simple need. A fund which goes very well in a rising market and a fund which falls little less in a falling market is a great fund. People don't really, and defeating the benchmark is not an investor's goal. Defeating a benchmark is what the fund industry has actually devised as a story to be, and you people will be first-hand, evidence of all this. Investors want the sense of being well off, being in control, being taken care of, and they will have enough. They are not looking at, point to point, beating the benchmark by 25 basis points, which it has been turned into. So, and in India, and I'll just cite you one more example. The largest small cap fund, it is about crossing 30,000 crore now, and it is spread over 270 stocks. And if you look at the benchmark return as compared to that, it is beating the benchmark hollow over a 20-year period. That I think is something which we should take back home.
Great. Thank you so much, Gath, and thank you for indulging me. And there's just one thing that I wanted to make an observation before we end the evening, is that the self-control, the discipline, the maturity, the professionalism that is being today displayed by the arm distributor is phenomenal. So not only have we seen changes in the way AMCs behave, manufacturers behave, we've seen a significant change, and we've been chronicling it. Last 14 years, I've been making a living out of interacting with these people. And the quality, the professionalism, the commitment, the customer centricity which has been shown by this community is phenomenal. It is very, very different from what it was there, say, 15 years back when I started Cafemutual. So on that note, let's end it.